Hi, everyone. This is Shailee Adinolfi from ConsenSys, where I do product sales and services, joined with Alex, Kyle, Matt, and Jesse. And we'll just go ahead and get started in talking about the next generation of DeFi platforms. Alex, please tell us about yourself, company, and what you've learned from your users so far, and then we'll just kind of go down the line.
Cool. Hey guys, I'm Alex. I'm the co-founder and CTO of SET. We're building a asset management protocol that empowers traders and asset managers to access all the opportunities on DeFi and to bring those to the broader market. We ultimately believe that users will gain exposure to DeFi through delegation and management instead of directly interacting, say, with smart contract money markets. And so it's important for us to make new user access as frictionless as possible. As an asset management protocol, we essentially focus a lot on integrations with other protocols. And so you'll find that our history follows the timeline of innovation with regards to tokenization of various assets. So starting late in 2017, when there was a flood of utility tokens as a result of ICOs, you saw that users really wanted maximum exposure. And so we focused on a smart contract representation of an index and essentially performed curations of baskets that people would want. Later in 2018 and 2019, we saw the rise of the stablecoin, and at the same time, a lot of consolidation back into essentially just Bitcoin and Ethereum. And so we took that time to release a rebalancing token standard, which is a token that you could hold that would rebalance underneath the hood. For example, between Ethereum and stablecoins based on some kind of strategy that would help you accumulate more ETH. And now in 2020, with the advent of tokenized pools, interest-bearing tokens, and yield farming, we're focused on enabling delegation on top of those protocols and their assets. I guess in the context of this panel, delegation and asset management creates a really interesting UX dilemma in that users are very keen on the rewards of yield farming and just token price action in general. And I think as a result of that, sometimes they're quick to give up some of that self-sovereignty that's afforded to them by Ethereum. They'd rather give up their private keys, deal with APIs, and basically they want to interact with lower latency services. But in doing so, you sort of forfeit some of the properties that really give DeFi its capital efficiency. Things like, for instance, being able to take your ETH and stake it on BZX, simultaneously make a trade for DAI, and then stake that on Curve. Being able to do that frictionlessly is really what gives DeFi its power. And so our job is to navigate this line and really decide what makes sense to abstract while basically retaining as much of that self-sovereignty for our users and traders as we can.
Kyle, you're up.
Hi, my name is Kyle Kistner. I'm co-founder of BZX. We're a margin lending, borrowing, and trading protocol. We've been building on the Ethereum mainnet since 2017. We had the first ever decentralized margin trade take place on our platform using liquidity from Bamboo Relay, which is a 0x relay. We originally started building a 0x style shorting platform, and we're trying to integrate with various 0x dexes. We've done a lot of innovations along the way. For example, we were the first to propose tokenized loans. So, those as I tokens, C tokens, etc. We were the first to have product market fit for tokenized margin positions. We have two products, Fulcrum and Torque. Fulcrum is a platform that is a generalized DeFi margin trading platform. You can go 4 times long on your favorite coin or 4 times short. And you can also lend out those coins at the same time. And we also have a platform named Torque. Torque is a borrowing platform. It's similar, you could say it's similar in some ways to like Aave or Compound. We offer fixed rate, indefinite term loans. That doesn't mean infinite term loans. It means without a set end date. Yeah, so that's a little bit about us, and we're happy to be here.
Thank you, Matt.
Hey guys, I'm Matt Beale. I'm one of the co-founders of LinkPool. So we're not strictly a DeFi product as such, but we operate a Chainlink node, and we were the first third-party Chainlink node and ecosystem developer. So we've got a few services, so I'll just run through those quickly. So we obviously run the Chainlink node. Our Chainlink node currently serves around about 20 price feeds, which are obviously used to provide reliable and fast on-chain price data for a variety of DeFi protocols. So I believe Kyle and Alex's protocols both use them to some extent. A price feed is essentially an aggregated response of several nodes, each of which get their data from a different external source. Because of their decentralized nature, these feeds produce kind of the most reliable, accurate data you can get, essentially. And our node is paid in kind of link tokens each time a piece of data is retrieved. We also have our own kind of token, and what that does is it grants a proportional amount of the revenue that we generate as a company. It also has kind of a few other uses, such as granting access to our staking platform, and in the future there's going to be governance for it. Since all this revenue is generated from kind of DeFi protocols, you could essentially kind of maybe call our token a second layer DeFi token. I don't know. And then we have our staking app. So eventually, Chainlink is going to release staking, crypto equity for the network, whereby node operators have to have some skin in the game. So, do you mean if they're penalized for kind of providing bad data, then there's some sort of financial forfeit. But what we are seeing, we're obviously with the rise of things like liquidity pools and DeFi protocols like Aave and Yearn, we think there's going to be a lot of crossover between staking. So we're planning on ways that we can integrate that in our staking app. And then we have one of our kind of our main products now is called the Chainlink Market, which you can go on at market.link. So this is actually built for kind of developers and node operators to be able to list nodes and for developers to kind of find the data that they need to create a connected smart contract. You can see all the details about particular nodes, such as if it's verified, how many feeds it serves, what data sources it has available, all things like that. We've got some exciting updates coming for that this month, so that'll be really interesting. So those updates should actually help give further insight into kind of the DeFi world as well. And then we have something called our managed node service, whereby we offer up our Chainlink infrastructure that we've built kind of for third parties who don't want to run it themselves. Yeah, that's me.
Great. Jesse?
Hi, everybody. My name's Jesse Johnson. I'm the creator of Bullionx, which is basically a project we started that explores the value of value-staked non-fungible tokens. So a little bit outside of the realm of DeFi usually, but what we're working on is bringing those together, because if you're familiar with non-fungible tokens or NFTs, those are basically unique assets that live on the blockchain, and they can represent crypto art, or they have a lot of applications with blockchain gaming, where you have items that could potentially outlive the games they were originally built for. We're taking that and we've created a collectible called Bullionx, which actually wraps ERC20 tokens inside of the non-fungible, so that what you could do with that, the first iteration of that is Bullionx, where we took a stable coin and we used the gold Digix stable coin, which is 1 gram of gold equals 1 DGX. And we wrap those so you have specific amounts with actual weights of gold in these high resolution 3D collectibles. And we partner with games, we partner with projects, and we partner with a lot of crypto artists to actually create these rare, some of them like only 5 exist or only 1 exists. And then people are able to trade these on NFT marketplaces like OpenSea. So that was our first project. Currently, I am building Aavegotchi. Now, Aavegotchi is powered by Aave. And it's kind of the second iteration of this, where we said, okay, we've learned a lot building with these stable coins, but we want to do more and look at other tokens out there. And Aave offers such an array of A tokens that actually are interest generating natively. So you're able to stake these inside of our cute pixelated ghosts called Aavegotchi. And if you remember, the name is obviously a reference to Tamagotchis from back in the 90s, our favorite digital pet. And so this is a gamified version of DeFi, And what we hope to achieve with that is to make it more accessible, more friendly, and also to encourage best practices. Safety farming is something Stanley at Aave has talked about, and that's part of what this initiative is about, is encouraging people to hold the A tokens and not necessarily over leverage or do something risky with them. And at the same time, be rewarded by entering this metaverse that basically has all sorts of applications, where basically what we're going to have is a DAO governance structure using a native ghost token. And then by collecting, fighting, training your Aavegotchi, you're actually going to be able to improve or level up your ghost and play with this idea of dynamic rarity, where one day your NFT is the most rare or in the 95th percentile, but maybe tomorrow, because somebody upgraded with a wearable NFT or farmed some better ones, you're actually less rare the next day. And the rarer you are, the more ghost tokens you actually are able to farm. So this is the idea of rarity farming that we're experimenting with. And I think this will directly impact DeFi in a couple ways. We want it to be something that makes DeFi, people that haven't looked at DeFi yet but are interested in crypto, feel more comfortable and willing to check it out. And also people that have never used crypto before, this ultimately is that kind of tool. Everything we build, whether it's Bullionx or Aavegotchi, or even my first project in NFTs was Mintable, they're all geared towards being code-free, extremely intuitive platforms that people can use. So that's what we're building, and I think it's really an exciting time to be combining NFTs and this value staked idea with the power of DeFi.
A bunch of things with regards to friction that you're experiencing, areas of opportunity to reach out to make things more accessible for users. What have been the biggest barriers, or what is the community, the DeFi community, facing as the biggest barriers with regards to user experience from your point of view, and what are you doing, or what do you seek from the community to make that better? I guess, Alex, you had mentioned abstraction, gas abstraction, and
sure, yeah. I actually,
that.
one of the things that I think continues to plague the space, not necessarily for people who are already in DeFi, but for those who are on the outside looking in, is certainly still Ethereum onboarding. I think there's a ways to go, and some of the friction comes in a couple of different varieties, right? One is the fact that you need to have a seeded wallet with Ethereum. That in and of itself introduces many layers of dependencies, right? Even as a seasoned user, when I go to Coinbase and I hit withdraw, I kind of hold my breath and say, like, what are the systems that they've built under the hood that make sure that my tokens end up in my wallet? And I think that sometimes spells friction for new users, whereby they'd rather just stay on the centralized platform. Alternatively, there are services like Wire that are able to do ACHs directly from your bank account and provide you a seeded Ethereum wallet. But even those come with a pretty high sticker shock. So I think there's definitely a lot more that we could do to make onboarding for entirely new users much more simple.
Yeah, so I think some of the biggest problems we're facing right now is, as DeFi, and this goes broadly across the industry, liquidity is user experience. And so we're still suffering from very low liquidity relative to the centralized exchanges. And I think this liquidity farming craze, as it applies to the decentralized exchange sector, is very much helping us overcome these network effects that the centralized exchanges have. But until we reach a certain tipping point, we're going to continue to struggle on that front. The other thing is, really, it's the user experience. So and it's honestly, it's everything that goes into using MetaMask. So onboarding onto MetaMask is just the first issue. Then the second issue is okay, you have your MetaMask running. Behind MetaMask, we have this whole node infrastructure. We have Infura running, right? A lot of the times where the node infrastructure is not really able to keep up with the demand. And, it's not clear that node infrastructure has been properly incentivized to be robust. And a lot of companies are having to pay for node infrastructure, which sort of undermines to some extent the decentralization of their front ends. They're going away from Infura, they're going towards Alchemy or QuickNode or something like that. But then even still, people using MetaMask are running up against problems with Infura. And then even as they get past that and they're able to submit transactions to the blockchain, they're still having issues because we have this crazy tipping system for the gas options. And then it runs them into a problem where, oh, I didn't put it a high enough gas price. And now, congestion is moving all around. And now I'm trying to put a new transaction in, or I'm trying to cancel it. And now I have this whole backlog and my entire system is broken. So it's just multiple layers of, how the ConsenSys layer works, how we interact with the ConsenSys layer, how we've incentivized the infrastructure that lets us interact with the ConsenSys layer, and all the way up. So and then the liquidity that we get from DeFi. So all of these things are really big challenges that I think, once we're able to solve, it's going to really help us move forward.
Matt, do you want to add to that from your perspective? Because I know you're not experiencing those Ethereum-related gas price issues, but what are you looking forward to from a?
No. So in terms of kind of high gas prices, so we actually take the kind of the brunt of that at the other end, because we are effectively the ones that are paying for kind of each Chainlink job that is ran. So a higher gas price for us obviously means that our node costs more to run, and therefore we make less profit. The thing with Chainlink nodes is they always need to pay the fast gas price. Obviously, a long block confirmation time will give kind of quite delayed results, jeopardize the DeFi apps using the feeds, and then kind of jeopardize them by introducing front running. So with high gas prices, I think an interesting dynamic is going to evolve, whereby the price of Chainlink, how much nodes are paid, and how much value is being stored in DeFi is all going to kind of relate to each other. So that's really our experience of kind of high gas prices, but I can't say much to the end user, unfortunately.
So we only have a few minutes left, unfortunately, to wrap up by 5:35. So we didn't have as much time as we wanted, but I'm going to ask you one more question, and that's we did our own open finance system, right, on Ethereum and Chainlink, but. So we still need that institutional buy-in and participation, right? Are we at the tipping point? And what next happen, I guess? We're learning that's happening with users. And I guess ETH2, any views on ETH2? I'm just throwing it all out there because we're running out of time.
Yeah. I mean,
that's right.
I think one big point that we haven't really touched on is governance. And there's a lot of governance tokens coming out. And that's going to be a tipping point as people can feel inspired and connect. Then that's very important for us getting to the next level and making good on the promise of these governance tokens. And I think in our case, what we're trying to do is, it kind of goes back to Kyle's point about MetaMask and drop transactions. We learned a lot through that, where we started developing collision prevention methods because we do event-based releases of these NFTs. And so what you have is two people trying to mint the same token ID at the same time. The faster one gets it, the other one has a drop transaction and pays. That's a friction. And that's led to the idea of event-based DAOs. So our DAO will actually have a town hall UI in like a video game type setting where you're able to interact. And I think some of these non-technical solutions can actually benefit everybody a lot. And that's kind of where we're focused and innovating, is on these intuitive ideas that are not necessarily technical, but we haven't really seen them applied to blockchain yet.
I want to make
And in regards to it,
go ahead.
Sorry, go on, Jesse. Oh, cheers. So in regards to kind of the tipping point, I don't think we're quite there yet, but obviously the volatility of crypto is something that's typically been quite a significant risk factor for institutions and VCs, and kind of kept them away from crypto in general. I think with the rise of stablecoins and increase of native asset hedging opportunities in DeFi protocols, this volatility is getting mitigated while still providing better returns than a typical finance system. And in most cases with a lot more flexibility and friction. So this is why we're actually seeing, I think, why we're seeing a lot more VCs start to invest in DeFi projects recently. So for example, Compound had, as you may know, quite a big VC backing. And I think that's because they realize now that they can provide better financial instruments with DeFi with a more acceptable level of risk. And I think as the risk decreases, the benefits for institutions may force their competitors to enter the space in order to protect their margins. So maybe that's the tipping point when the competition between these institutions starts kind of firing up and they start kind of trying to challenge each other to go and get on board.
So, you know,
Kyle, then
so I would just kind of like break this down a little bit more. Like, so what do we mean by institutions getting into DeFi? Do we mean like what Matt said about VCs investing in DeFi companies? Do we mean institutions actually using DeFi? Do we mean institutions supporting the infrastructure for DeFi or participating in DeFi in a way that brings in more end users? So I think, you know, right now we could say that DeFi actually does have quite a bit of VCs investing, traditional institutions investing. You know, Compound's not the Lone Ranger set protocol. I mean, even us, we've had, you know, more traditional VCs investing. So I think that's not, you know, I think that tipping point was actually reached quite a bit ago. But I think people were also waiting, like around 2017, 2018, you know, during the bear market, people said, don't worry, the institutions are going to come in, and with the implication that this is going to raise the price and that we need them in some sense. And I think, you know, and then more on the business side, we would talk to people and we'd say, oh, you know, DEXs really need institutions to come in and do market making in order to provide liquidity, but they're getting really stymied by regulatory issues. They need to know who their counterparty is. So this is what's stopping DeFi from taking off. We have this counterparty issue. We don't have institutional liquidity providers. But I think what we're increasingly finding is that we don't need institutions. We like,
right.
I mean, you know, when I think about it, I'm personally like, who cares if they come or not? They have very little relevance to like what I think about in the day-to-day business or even the medium-term objectives of what we're doing. So I think these narratives made sense in the past. And as we're increasingly seeing, like, we can get liquidity without them. We can figure out ways to market make using like the people's money without these big institutions calling the shots. And we're still, you know, we still have these old habits of thinking we need them, but maybe we don't.
Yes and no, right? To a certain degree, like there are opportunities for like massive liquidations, for instance, where I think you'd be hard pressed to find users with that much ETH or who are able to buy that much DAI to, you know, be a maker keeper, for instance. And so there are still opportunities for them, but at least of the players that we've talked to, I mean, they've made it clear that they're really not interested in participating until there is a clear, for instance, like $10 million a year return. And to be honest, I think that's fine, right? Like they've carved out an expertise within the existing financial system, and they feel like they don't have a reason to divert. But more importantly, like this gives room for mid-size and smaller players who are willing to invest like the years of growth with us, and really allowing themselves to mature as the institutions of DeFi. And some anecdotes from our end, some of our market makers who have helped us carry out our 8-figure rebalances on our protocol. We walked through the anatomy of transactions. We walked through Etherscan with them. We literally like handheld them to get to where they are today. And as a result of that fluidity of DeFi, they were the ones who were able to really take advantage of Compound's distribution and Y earns yield farming. It's because they had gone through that with us. And so, I mean, all I really have to say is that the institutions who are still waiting on the sidelines are risking being left behind very quickly.
Excellent. I have to wrap this up. Thank you so much for your time. Sorry that we couldn't keep talking. Maybe we can have a separate happy hour with us, just continuing the conversation. It was lovely, and take care. On to the next session.
Thanks,
Bye.
Shailee.
Thank you.
Thanks, everybody.
It's been a pleasure.